Okay, so you want to own a McDonald's. The golden arches on your own corner lot. A drive-thru with a line that never really stops. The single most recognized brand in the history of food, with a proven system, a 50-year track record, and customers who were loyal to it before you were born. You don't have to invent a menu, build a brand, or convince anyone to try your product. You just plug into the biggest fast food machine ever built and collect your share. That's the plan in your head, and it's not a bad plan. Stand in a busy McDonald's at noon, and it looks like the safest business on earth. Every register moving, the drive-thru wrapped around the building, a kitchen running like a factory. You look at that and you think, millions of customers, a burger that costs almost nothing to make, and a name everyone on the planet already trusts. This has to be as close to a guaranteed business as money can buy. Here's the problem. Almost everything that makes McDonald's the safest brand to operate is the same thing that makes owning one far less profitable than you think. And it comes down to who actually makes the money in this arrangement. And it isn't the person flipping the burgers. Because when you buy McDonald's, you are not buying a business. You are buying permission to run one, on terms written entirely by someone else, in a building you usually don't own, selling food at prices you don't fully control, and handing a slice of every single dollar back up the chain before you keep a cent. The truth is that McDonald's, the corporation, is not really a hamburger company. It is one of the largest real estate operations on the planet that happens to sell hamburgers. And once you understand that, the entire relationship between the corporation and the person who owns the restaurant snaps into focus. Let's start with what it actually costs to get in the door, because the number surprises almost everyone. To open a traditional McDonald's, the total investment commonly runs somewhere between $1 and $2.5 million, depending on the location, the size, and whether it's a new build or an existing store. That covers the kitchen equipment, the signage, the seating, the decor, the initial inventory, and the franchise fee itself, which is around $45,000 paid up front. But here's the requirement that stops most people cold. McDonald's requires that a large share of that investment, commonly around $500,000, be liquid cash that is not borrowed, not a loan, not equity in your house, actual unencumbered money you already have. Which means the person who can realistically buy McDonald's is, almost by definition, already wealthy. This is not a business you bootstrap. It's a business you must be rich before you're allowed to enter. Read that again. $500,000 in cash that you didn't borrow just to be considered. And even if you have it, having the money is not enough. McDonald's does not simply sell franchises to whoever writes the check. They run one of the most selective approval processes in all of franchising. You apply, you interview, you go through an extended training and evaluation program that can run many months, sometimes working unpaid shifts in existing restaurants to prove you can actually do the job. They're not looking for an investor. They're looking for an operator. Someone who will stand in the store and they screen hard for it because the brand's reputation is on the line in every location. Now here's where the naive model starts to break down. You think that once you've paid to get in, the restaurant is yours and the profits are yours. Neither is fully true. And the reason is the structure of what you actually signed. Start with the building, because this is the heart of the entire thing. In the vast majority of cases, you do not own the land or the building your McDonald's sits on. McDonald's, the corporation, does. They select the site, they acquire or control the real estate, they build the restaurant, and then they lease it to you, the franchisee. Which means that on top of everything else, you are paying rent to McDonald's every single month, and that rent is not a flat number. It is frequently calculated as a percentage of your sales. So the better your restaurant does, the more rent you pay. This is the piece that outsiders almost never understand, and it's the key to the whole business. Decades ago, McDonald's realized that selling franchises and collecting royalties was a fine business, but the truly durable money was in owning the ground underneath every restaurant. A franchisee might succeed or fail, might renew or not, but the land keeps its value and the rent keeps flowing. The corporation's own early financial architect is famous inside the industry for pointing out that the company was not really in the business of hamburgers. It was in the business of real estate, and hamburgers were how the rent got paid. So let's add up what actually comes out of your sales before you see $1 of profit, because this is where the dream meets the arithmetic. First, the royalty. You pay McDonald's an ongoing service fee, historically around 4% of your gross sales, for the right to use the brand, the system, and the supply chain. That's 4 cents of every dollar, off the top, forever. Second, the rent. The percentage of sales rent paid to McDonald's for the building can run substantially higher than the royalty, often in the range of 8 to 12% or more of sales, depending on the location and the deal. Stack the rent and the royalty together, and you can be handing well over 10 cents, sometimes closer to 15, of every single dollar of revenue straight back to the corporation before you've paid for a single employee or a single beef patty. Third, advertising. Franchisees are required to contribute a percentage of sales, commonly around 4%, into the national and local marketing funds. That's what pays for the ads you see everywhere. It's genuinely valuable, but it's another slice off the top, and it's not optional. Now stack all of that against the cost of actually running the place. Food and paper costs. Labor, which is the single largest controllable expense and has been climbing hard as wages rise. Utilities, to run a kitchen full of fryers and freezers, and a dining room and a drive-thru, 16 hours a day. Maintenance, repairs, insurance, and the constant reinvestment McDonald's requires you to make. Because the corporation mandates periodic remodels, new equipment, and upgrades to keep every location looking current, and those remodels can cost hundreds of thousands of dollars that come out of your pocket, not theirs. When you run all of that math, here's what you find. A McDonald's restaurant generates enormous revenue. The average traditional McDonald's in the United States does well over $3 million a year in sales, and many do considerably more. That top-line number is genuinely huge, and it's the number that makes people think this is a gold mine. But the profit that actually lands in the owner's pocket, the net margin, commonly runs somewhere in the neighborhood of 10 to 15% of sales after everything is paid. On a restaurant doing $3 million in sales, that might be $300,000 to $450,000 of profit before the owner's own debt service on the money they borrowed to buy in. Now, that is a real income. But look at what it took to earn it. You needed $1 million or more of investment, half of it in unborrowable cash. You work or closely manage a business with dozens of employees, razor-thin margins on each transaction, and a demanding corporate partner looking over your shoulder. And that 10 to 15% is what's left after the corporation has already taken its royalty, its rent, and its ad fee off the top, in good years and bad. This is the central inversion of the whole business. The franchisee takes on almost all of the operational risk, the labor headaches, the local competition, the cost inflation, and keeps a thin slice of a huge number. The corporation takes almost none of the daily operational risk and collects a steady, compounding stream of royalty and rent off the top of that same huge number across tens of thousands of locations. You are running the restaurant. They are running the toll booth. Now here's where the psychology and the control become as important as the math, because owning a McDonald's is unlike owning almost any other business you could buy with the same money. Start with the fact that you don't really control your own product. The menu is set by the corporation. The recipes are set by the corporation. The suppliers are approved by the corporation. Even your prices are heavily steered by the corporation through suggested pricing and national promotions. When McDonald's decides to run a nationwide deal that sells a product at a razor-thin margin, you often have to participate, even if that specific promotion hurts your specific restaurant's economics that month. You bought a business, but you did not buy the right to run it your way. Then there's the location itself. You don't choose it freely. McDonald's controls where restaurants go and controls whether a new McDonald's opens near yours. In most agreements, you are not guaranteed exclusive territory the way you might assume. The corporation is optimizing for the total system, the total brand footprint, and what's best for the system is not always what's best for your single store. Then there's the term. A McDonald's franchise agreement typically runs about 20 years. At the end of it, renewal is not automatic. The corporation decides whether you've operated well enough, invested enough, and maintained the standards to be granted another term, which means that even after 2 decades of building a business, you don't fully own your own future. You're a long-term tenant of a brand, and the brand holds the renewal. And this is the quiet leverage that runs the entire franchise relationship. Because you had to be wealthy to get in, because you sank $1 million+ and years of your life into the store, and because walking away means losing that investment, you are powerfully motivated to keep the corporation happy, to fund every mandated remodel, to run every promotion, to hit every standard. The very size of your commitment is what keeps you compliant. The franchisee isn't just paying rent on a building. They're locked into a system that they've invested far too much to leave. Before we get to how a McDonald's owner can actually lose, it's worth naming the things you're really buying, because they're not nothing. You're buying a supply chain of enormous scale that delivers consistent ingredients at prices a single independent restaurant could never negotiate. You're buying a brand so powerful that a new location can be profitable almost from the day it opens, with none of the slow, terrifying buildup an independent restaurant faces. You're buying operational systems, refined over 70 years. And you're buying a real estate location that the corporation, which is very good at real estate, selected specifically because the numbers work. These are genuine, valuable advantages. The catch is simply that you pay for every one of them, continuously, off the top, forever. So how does a business this proven, with a brand this strong, ever actually hurt the person who owns it? A few ways, and they're worth understanding before you fall in love with the golden arches. The first is labor and cost inflation crushing a thin margin. Because your net margin is only 10 to 15%, and because your 2 biggest controllable costs, labor and food, are both subject to inflation you can't control, a sustained rise in wages or beef prices can compress that margin toward zero. And you can't simply raise prices to compensate because your pricing is steered nationally and your customers are extremely price sensitive. A restaurant doing $3 million in sales can go from comfortably profitable to barely breaking even without a single thing changing except the cost of labor and the price of ingredients. The second is the mandated remodel arriving at the wrong time. The corporation decides the whole system needs upgraded kitchens, new digital kiosks, a redesigned dining room, That can be a several $100,000 bill, and it's not a suggestion. If it lands in a year when your margins are already tight, you're borrowing more money to reinvest in a building you don't even own to protect a franchise you don't want to lose. The third is buying the wrong store, or too many stores with too much debt. Many McDonald's owners operate multiple locations, and they finance them. If an owner over-leverages, buying store after store on borrowed money, a downturn in sales across their group can leave them unable to cover the debt, the rent, and the royalties all at once. The brand keeps collecting its percentage off the top, regardless. It's the owner's equity that absorbs the shortfall. So let's put it in plain mechanical terms. Take a single traditional McDonald's, doing $3 million a year in sales, which is roughly average. Off the top, the corporation takes its service fee of around 4%, its rent of, say, 10% of sales, and its advertising contribution of around 4%. That's roughly 18% of your $3 million, or about $540,000, gone to the corporation before you've paid a single worker. Then the operating costs. Food and paper might run around 30% of sales. Labor, another 25 to 30% and climbing. Utilities, maintenance, insurance, and everything else, another 10 to 15%. Add it all up, and on that $3 million in sales, the owner is often left with something in the range of $300,000 to $450,000 in profit before their own loan payments on the money they borrowed to buy in. That's a genuinely good income for one restaurant, but now weigh it against what it demanded. You needed to already be a millionaire to qualify. You committed a decade or two of your working life. You took on all the operational risk, and you kept a thin slice while the corporation collected its steady percentage off the very top in every store, in every economy, forever. In the optimistic version, you run the store beautifully, you keep labor tight, you eventually own several locations, and you build real generational wealth. And this genuinely happens. Because a well-run multi-store McDonald's operator can become very wealthy. In the realistic version, nothing exotic goes wrong. Wages rise across your market, and you can't cut hours without hurting service. Beef and chicken prices climb. The corporation mandates a $400,000 remodel the same year your margins tightened. A new McDonald's opens 6 miles away and splits your customer base. Your fixed costs, the rent, the royalty, the ad fee, don't move an inch because they're percentages the corporation collects no matter what. And that comfortable 10 to 15% margin slides toward single digits. And a very good year and a very hard year can differ by hundreds of thousands of dollars on the identical store, with the corporation's cut looking exactly the same in both. The gap between those two outcomes, the wealthy multi-store operator and the squeezed single-store owner refinancing to fund a remodel, is enormous. And almost none of it shows up as a dramatic event. No fire, no scandal, just wages ticking up, a promotion you were required to run, and a remodel bill you didn't choose the timing of, compounding quietly until the number at the bottom of the statement looks nothing like the $3 million top line that made it all look so easy. So, if you do buy a McDonald's, understand exactly what you're buying and what you're not. You're not buying a hamburger business, and you're certainly not buying independence. You're buying a license to operate the most powerful brand in food on a piece of real estate the corporation owns, under rules the corporation writes, in exchange for a permanent slice of everything you sell. The Golden Arches were never really the customer's destination. They were the corporation's toll booth, and you signed up to run it. The person flipping the burgers takes the risk. The company that owns the ground underneath collects the rent. And that, far more than any secret sauce, is the actual economics of the most famous restaurant on earth.